Hello and welcome to our latest financial market commentary. I'm going to talk about what's been happening to financial markets during the course of 2018, and as we get to the back end of the year, what the future holds as far as 2019 is concerned. Certainly it's been a very volatile year for financial markets, and we should expect more of the same next year too. So it's important that client portfolios need to be positioned correctly to get the best possible returns in what is certain to be a very challenging environment. So what's going on? Well, the answer isn't Brexit, I'm afraid. Brexit is a big distraction for the moment. It's certainly important for the UK, but the reality is that as far as global financial markets are concerned, it is a sideshow. The big story is US interest rates. US interest rates drive the cost of money throughout the global financial system, and they are on an upward trajectory. In fact, over the last year or so, US interest rates have practically doubled, and we are set to see further increases over the next 12 months, the first of which might be as soon as December. Not a very helpful Christmas present for financial markets. So why are US interest rates so important? Well, ultimately, much of the money that flows around the global financial system is American owned, and how much investors charge for the use of that money influences the net present value of so many investments. Ultimately, if you look at an investment like a share, an equity, and the dividend income that might come from that, or the future earnings growth that might come from that investment, or indeed interest payments from bonds or rental receipts from property, the net present value, in other words, what is it worth today, of your anticipated future cash flow is driven by the cost of money over the duration of the term that you are thinking about. So if money costs twice as much, the current value of assets, all assets, is lower than it might have been before. And that's why we are seeing so many stresses and strains in the global financial system. Now, it doesn't mean that companies generally are performing poorly. In fact, if you look at the US as an example, on average, US companies are enjoying earnings growth of about 20% in 2018. That's a fantastic level of improvement in profitability. Why is that happening? Well, actually the US economy is doing pretty well, helped to a great extent by a huge stimulus engineered by Trump, which is a tax giveaway worth something like $1.5 trillion a year. And that money is flowing into the coffers of companies, into the pockets of consumers, and helping to drive along their economic recovery. As if life wasn't complicated enough, trying to take into account the likely pathway for US interest rates, we also have to think about currency. The US dollar has been pretty strong over the course of 2018. Of course, the reason for that is that dollars now pay more interest than they did previously, and investors are moving into the dollar from other currencies in anticipation of future increases in interest. Now, if you're having to pay interest on your dollars that you've borrowed using another currency which is depreciating relative to the dollar, that is a double whammy. And it is the reason why many emerging economies are currently struggling, because they're seeing an outflow of money as it returns back to the US to be invested in dollars again, and in addition to that, the cost of their dollar-denominated borrowing is rising, and that is denting the profitability of many companies that are domiciled in that area. Another factor is liquidity. The US Federal Reserve printed an awful lot of money as part of its quantitative easing program. It's now moved to what we call quantitative tightening, where it's effectively shredding money. At the moment, the US Federal Reserve is shredding something like $50 billion a month. That's money being taken out of the financial system and cancelled off against the money that was created to rescue the financial system from the banking crisis. Again, that's starting to have an impact. Now, certainly as far as the UK is concerned, the obsession at the moment, as I mentioned before, and as we all know, is Brexit. But despite that, the economy is performing reasonably well. If you look at the very big companies in the UK, they are less affected by what is happening, because most of their trade is actually outside the UK. So for example, if you look at the top 100 companies in the UK stock market, the FTSE 100 share index, they earn almost 3/4 of their revenues overseas. The most damaging thing, of course, for the UK is the uncertainty. So it's smaller and medium-sized companies that are more domestically focused that are suffering most, and they're suffering simply because of that lack of confidence in the UK. There's been a big reduction in inward investment, that's overseas companies invested in the UK. And UK companies too are sitting on their cash, they're not invested in new capacity because they don't know what the future holds. So we just need our politicians to get on with it and give us a much clearer framework so that companies can start to make the decisions that they need to make in order to continue to grow. So looking forward to 2019, there are certainly a lot of threats on the horizon, but there are opportunities too. I think that there are a number of types of investment that are mispriced, and that creates, I think, the ability for us to again start to reposition our portfolios for clients to ensure that they can get the best possible results. Now, it's always important when you look at investments to recognize that a good investment can actually easily become a bad one, and a safe investment can become a risky one. And the key thing that makes that change is what you pay for it. If you overpay for an investment, you change its characteristics. And I think there are opportunities at the moment where some parts of the financial markets are maybe a little underpriced. So in summary, 2018 I think has been a long time in coming. We've been anticipating this inflection point where we move from monetary policy globally being very supportive, a stimulus, to monetary policy tightening. And the US are leading the way because their economy recovered more quickly, so they're going to tighten more quickly, and things are now starting to happen that we expected to happen probably a year or so ago. So we've positioned our client portfolios to anticipate this volatility, and as a consequence, values have held up really well. On a year-to-date basis, portfolios are typically down by 1%, and that compares to the FTSE down by about 5%, UK bonds down by over 1%, and property securities, as in shares in property companies, down by 4 or 5%. So we've been performing very well. The reason for that is that we've taken a very strong position, strong exposure to the US dollar throughout our portfolio, not just on the equity side, but also through bonds, fixed interest securities, and commercial property. And that has given our portfolios a lift relative to what might have been achieved had we followed a more UK-centric pathway. Just to remind you about our approach to investment management, it's really important, in our view, to take a medium-term view. It's no point trying to play financial markets, trying to make a quick buck over the next month or so, because the reality is it's far too difficult to predict what's going to happen. There are so many different variables. And also there are a lot of people competing to make money over that time frame. So it's best to take a medium-term view. We're always looking forward 2 or 3 years, because over that time frame it's much easier to predict what's going to happen. And as a consequence, we can align our client portfolios so that over time they reap consistent benefits and they're less influenced by short-term volatility. And that's definitely the right approach, and I don't see that changing anytime soon.